Now today we're going to understand in economic analysis for forex trading and can be applied in equity and as well as commodity. So we'll start with the very important concept of inflation and interest rates. So these are the tools which actually steers your economy. Cool. Now, so let's understand the interest rate and the inflation and all. So let's first understand inflation. What is inflation basically? Now, this is, let's suppose you, and luckily you got married, so you are now a couple and you have a family income of $1,000, and with God grace you get a kid, so you have a kid now, and kids ask you for $100 as pocket expense, a monthly pocket expense. So you pay him. It's well good, you have a nice sweet family. Now, so after some times you know you're doing great, so your kid grow up a little bit and very soon he start drinking beer. Let's say at the age of 5. God bless, nobody does that, but I'm just giving you an example, so consider it. So you think that the kid is now spoiled, like we cannot handle, so you plan for another kid. Now another kid is also asking $100 for pocket expenses. So because the elder brother was drinking a lot of beer, so he got influenced with him and so went to the beer shop. And now both together enjoy the beer. Now the parents were like a little bit astonished and a little bit worried, so they planned for another kid. Now another kid was also asking for a pocket expense of $100. And obviously when two kids are spoiled in the family, the third will also get spoiled. So normally, so not exceptions are there. So he is also drinking beer. Now what happens is the demand of beer will increase if too much of population is increasing basically. So when the demand is increased, so the price of the beer will be raised by the bar, beer bar owner. So basically this is called a demand pull inflation. Okay, so if there's too many people coming into the same beer bar, the price of the beer may increase. Now let's understand further in the same story. So he already had 3 kids. Now he plans for 2 more kids. We cannot help out. In good old days people used to do this thing. They didn't have to do anything else. Just kidding. So let's say the family guy was having trouble in maintaining the family household expenditures on a month-to-month basis because his income was only $1,000. So what he did is he asked for a hike in salary due to increasing family expenditure. Now, so the second option, he could have looked for a loan from bank to bear the expenditures. Now, so loan was not a solution because you have to repay and you don't save. Your expenditures are more than your savings, your income. So first option was not good for the family to take, the husband and wife. So they asked for the company. So the company had 2 options to raise the price of labors because the population was increasing, the demand was increasing, the inflation was increasing. So the factory owner gave him 2 options. There was 2 options for factory owners before he could increase the salary. One is that they increase the sales. So that means tell all the employees to generate more sales. So if we have more sales, we have more revenues, we will increase the salary. Second option was rise the price of product. So when you rise the price of product, you're doing because of the cost pull inflation. So that is called because of the wages increased. So if you rise the price of the product because you have to increase the salary, so you have to increase the price of the product, so that will increase the inflation. So that is basically cost pull inflation. Now then we have another option, which was increase the sales. So if this guy, the husband and wife both are working with the company, this company says to increase the sales. Now these people have to go to the new customers because already the old market was already saturated, tapped. So there were new guys, new children, new kids. They were growing, so they were new customers. So they have to attract new customers. They have to sell their products to new customers. Now in that situation, new customer will only become a buyer when they will get a job. Okay. So if they don't have a job, they cannot, become buyers. Now, so they have to go to the factory to get the job. Now, factory can only give new jobs when they have more sales. And more sales is only possible when the family expenditures are more, or they have good income, or maybe there are new customers in the market. When new customers want new job, so it becomes a vicious circle. Now, second option could be bank can give loan to the new customers or the new generation to become entrepreneur, start new business, something like that. So both the option could be there for new jobs. Now, or the factory owner can ask bank that give us some money on loan, and I think there is a new breed, not breed, I would rather say there's a new generation coming up looking for jobs, and there is a lot of possibility for new customers, new markets. So let's have, let's give us some loan. We'll scale up the business. We'll expand the production. We'll increase the production. We'll expand the factory, and we'll create more jobs. Now, so bank says that we can only give you loan when we have some savings with us. So we don't have money. Why? Because the people in the system, the economy, are spending more because they have more kids. The main culprit is population. So they have more kids, so they're spending more. Or government is asking for more taxes. So they are having no savings. If there's no saving, if we don't have money, so the bank cannot give loan to the factory. So the bank is also helpless. Now, what happens in the system is then the Fed Reserve, maybe, or the government prints the money, or government increases the expenditures. And basically, if the Fed gives money, it gives money to the bank on loan. Okay, you can say at the repo rate. Repo rate is the interest rate at which the central bank lends money to the bank. Now, so the government is creating money in the system by giving easier loan or cheap loan to the banks. And then the bank normally gives loan to the new entrepreneurs, new generation, or the existing factories or the business, so that they can, increase the business, and the economy keeps on, goes on a rotation, let's say, or the economic wheel is, is moving. So your economy's GDP is growing. So this money actually which is printed by the central bank goes to public and, as I said, the factory and all through the bank. Now, so in this situation, if too much of money is printed by the central bank, then what will happen? That will lead to more inflation. So the money printing is easy by the bank. They can print it, and they can print it through the thin air. So that falls under open market operations, one of the responsibilities of the central banks. So if there's too much of money supply, then there could be difficulty. So that will lead to high inflation. Now, if you take recent example of like Zimbabwe, what happened there? That was hyperinflation. A lot of money was printed by the government in the system. Why? Because the system was not generating revenue at all, business. And high expenditure, high inflation, suddenly mismanaging of economy. That led to disaster. So printing money is not the solution only. But yes, the immediate remedy could be to have more supply of money into the system so that we have a steady increase of inflation, but our economy will also grow. Now, so moving on further, let's understand how interest rate impacts the inflation. So let's suppose there are 3 people who wants to save. So they deposit money with the bank, and the bank pays interest on their deposits. Right? Now, so another source of money for the bank is to take loan from the Fed Reserve. So there's a cartoon of Ben Bernanke, the Fed governor, basically, in other states. So Fed Reserve. So bank has 2 options to take money, to have funds with them, to take loan from the Fed Reserve or the central bank of an economy, and the deposits from public, and pay interest to the public. And when they take loan from the Fed Reserve, they pay interest to the Fed Reserve. And as well as if they take deposit from the public, they pay interest to the public. Now, so there are people also in the economy, they need loan. So to them, the bank pays the loan. So they issues the loan. Now, and when they issue the loan, from the bank receives interest, okay, on those loans from the those guys who have taken the loan. So in that situation, normally the interest rate on loans issued by the bank is higher than the interest rate on the deposits. So that's the difference in the interest rate of deposit and the loan is the profit of the bank, basically, or the operating profit of the bank. Now, sometimes it happens that the interest rate is raised by the central bank, the repo rate, at which the central bank gives the loan to the commercial banks. So in that situation, the cost of the money, okay, is increased. The price for the money is increased. So in that situation, the cost is high. So bank is forced to increase the interest rate on the loans. So the interest rate is normally high. So when the interest rate is increased, many commercial banks follow that if the interest rate is increased by the Fed Reserve. So what happens in that situation? Loan demand decreases. So that leads to higher interest rates, leads to little slower economy because there's less expenditure. GDP normally reduces. So and normally real estate sector, banking sector, automobile sector, these are hit badly. And it's bad for the economy also, because high interest rate uh, or higher cost of capital will lead to higher prices of goods, and your companies and economy are not competitive in the international trade. So the interest rate should be low. However, so if interest rate is increased, the loan demand decreases. So higher interest rate will reduce the loan demand. So if they have less money to spend, so it will improve the inflation rate into the system. So there will be less money into the system, there will be less expenditure. Less expenditure means less demand. Less demand means the producer of the good has to reduce the price, so that will curb the inflation. So higher interest rate curbs the inflation in the economy. So how higher interest rates increase the value of your currency? Now, so what happens is, let's say if you have higher interest rate, there will be more people depositing money, and if there will be more deposits with the bank and higher cost of loan, they will be lesser spending. There will be less loans, less spending, and also people are saving more because they are motivated to save more, so they will spend more. So sorry, they will spend less, they'll save more. So due to this, the producers will be forced to reduce the cost of goods. Now, so if the cost of goods is reduced, it will slow down the economy. The economic growth will be less. Higher interest rate will reduce the economic growth. So that's why politicians are shouting, reduce the inflation rate, reduce the inflation rate. Now, but that will rise in FDI and as well as export. So if you have higher interest rate in an economy, the foreign direct investors, they are attracted in your economy. There is high interest rate, there will be high, returns on their investments. So they start looking towards the economy. Yeah, there are other conditions also, like safety, stability, political stability, many other things, the business environment and all. But yes, higher interest rate will increase or attract FDI, as well as if the entire industry reduces the price, so they get benefited in another term, because there is a rise in export. You become price competitive in the international market, and you start exploring other destinations, so that increase the export. Now both brings dollar into your economy, or the currency demand increases, INR, and your currency value rises. So there's a more supply of dollar into your economy, okay, or the INR is demanded more, both the ways. So your currency value increases. So normally if you have higher interest rate or increasing interest rate, that will increase the value. Now in near term, you seen notice that the recently we were on a fixed, the cash deposit rates were around 9% in India, 8.75. Now it is reduced to 7% something. So the currency is also depreciating. It's going from, let's say, 60 to 63 to 68, 67 kind of thing. And actually it's reducing badly. I can tell you one thing, if crude would not have been down, okay, crude is trading at a very low price. It's 3-4 years low, I guess. It's badly, it's 5-6 years low, I guess. So if crude would not have been at a low price, we would have had a really bad time. INR could have hit a low of as low of 72, 74 maybe. So crude oil price, reduced collars price or cheap crude oil has saved us a lot, because a lot of dollar goes out when importing crude oil. Anyways, so the higher interest rate will help you. But yes, you cannot keep interest rate high for a longer time because the economy suffers, GDP suffers. But yes, it increases your currency value. So you can visit us, iplanonline.in or maybe iplaneducation.com.